Hello everyone, it's Yashar here, back again with another video, and today I'm going to talk about 3 Canadian stocks that I'm actively buying or thinking about adding to my positions. I will share with you my personal opinion on these stocks, my fair value estimate, and I will also show you some recent interviews from management teams of these companies. All of these interviews that I included in this video happened in the last 2 weeks. So they basically reflect the latest point of view of CEOs and managers of these businesses. The first stock that I'm thinking about buying more shares of is Brookfield Corporation. I talk about this stock a lot on my channel, but after watching the Investor Day presentations, I actually think this stock deserves even more coverage. Brookfield Corporation is one of the first stocks I ever bought in my portfolio, and it is my third largest holding after Google and Meta at the moment. I have close to 33,000 Canadian dollar invested in this company, and I am up 90% on my position. The last time I bought Brookfield Corporation was in March, April, and May of this year, when the stock was trading close to 70 and 75 Canadian dollar. I constantly averaged up on my position and picked up more and more shares of the company during the tariff dip. Despite being one of my largest holdings at the moment, and trading at an all-time high share price, I still believe Brookfield Corporation is not expensive. I recently analyzed the stock in detail using discounted future earnings and some of the parts models, and we'll leave a link to that video in the description box if you're interested in details of the calculation. But in summary, I concluded that Brookfield Corporation fair value was close to 93 Canadian dollar at the time of recording that video. I think the recent development of the company with signing new long-term contracts with big tech companies to build AI factories should lift the previous valuation. So I believe the stock fair value today is closer to 100 Canadian dollar. So this is an amazing business which trades at a fair valuation at this point. So even at this price, even though it is already a large holding in my portfolio, I am thinking about buying more shares of Brookfield Corporation, especially after this recent Investor Day presentations, which is really exciting to me. Let's look at a couple of clips from Brookfield Corporation Investor Day. In the first clip, Bruce Flatt, the CEO of Brookfield, will discuss the return of the stock in the last 30 years, where the average annual return to shareholders was 19%, which is really impressive.
It doesn't sound like that much, but that's a 27,000% return over 30 years. So that's a pretty amazing return. What that means is that if you look at these returns, the S&P 500 did 11, we did 19, that's 800 basis points more every single year for 30 years. It wasn't every single year, but on average, it was every single year. What's more interesting, most investment strategies get worse as you get bigger. Our 20-year returns are 16, our 10-year returns are 17, our 5-year returns are 22. What it means is the business is maturing and getting better over time, and scale actually is assisting us get better returns.
Next, Bruce Flatt mentions the key advantage of Brookfield compared to other asset manager businesses. Once they realize a trend in the industry, they adapt and move fast at a large scale. As an example, we can talk about their AI factories, which are basically the high-performance computing and supercomputing infrastructure that they build as the backbone for both training artificial intelligence models and large language models, and also for AI inference, which is deployment of the trained models to perform tasks in real time. Let's look at these 2 short clips from Bruce Flatt, where he mentions these advantages of Brookfield and the example of AI factories.
Once we understand an industry, we move fast and we deploy at scale. We're not early, but once we understand it, we move fast and we deploy at scale. 50% of the assets that we operate with today didn't exist as an asset class for investable purposes 15 years ago. That's an evolution. On AI, you've seen our slides. this is a $7 trillion opportunity. We're ideally suited because of our power, our adjacencies, our compute infrastructure, our real estate businesses to participate in this. We have a number of AI factories that we're working on, which is around a $200 billion investment project over the next while, and this is just the beginning, and it's really just the start of what's going on in the world on the infrastructure side. This is a multi-decade opportunity that possibly is the largest business within our company within 10 years.
As seen in the presentation, Bruce Flatt believes that AI factories can become the largest part of Brookfield business in the next 5 years and bring the most revenue for the company, as Brookfield Corporation will provide both power and infrastructure required for these AI models. Next, he discussed their wealth solution business and described why they entered into insurance business and what they mean exactly when they mention that Brookfield wants to become an investment-led insurance business. Basically, there is a traditional insurance business like Intact Financial or Manulife, which focuses on insurance business and underwriting to obtain the profits. And then there is an investment-led insurance business like Berkshire Hathaway that use the float to invest in other businesses to make money. Brookfield Corporation wants to become something in between, but more similar to Berkshire Hathaway. Let's look at this clip.
And I'll touch on what we mean when we say that, because I think this is extremely important for you to understand. Traditional insurance underwrites insurance and tries to make money by underwriting insurance. It takes the float it gets and it gives it to managers and tries to not lose money. Make profit out of insurance, don't lose money on float, equals profitability of your insurance company. Most insurance companies operate that way. Investment-led insurance turns that upside down. We have extremely strong risk management. We try to achieve returns out of investments. We try not to lose money on insurance. We seek float. We don't seek scale. And it's really saying the opposite of what most insurance companies do. Insurance companies are good at what they do. They underwrite insurance. They're trying to make profits. Investment-led insurance is the exact opposite of that. And that's what we're trying to do with the business.
And finally, in this clip, Bruce Flatt talks about the future of BN business and what shareholders can expect to see as the return of the business. He mentions that they will still aim for 15 plus returns annually, and he actually believes it's easier to achieve 15% plus at this scale compared to 20 or 25 years ago when Brookfield was much smaller.
As always, and this is paramount, we remain focused on delivering 15% plus returns for shareholders. I think it's easier today than it was 25 years ago because of the scale and the business that we have within Brookfield Corporation. So welcome to the next chapter of Brookfield, and I'll turn you over to Nick Goodman.
Overall, I love what Brookfield is doing. They have a stellar track record of delivering excellent shareholders' returns in the past, and it seems they are involved in the right projects for the next couple of years. Stock is not cheap like 2 years ago, but I don't believe the stock is expensive either, and considering the quality of the management team and the business, I believe even here Brookfield is not a bad buy, and it should be able to still return decent amount of money to shareholders in the next couple of years. The second stock that I'm actively buying right now is Intact Financial. This is not a well-known business for most investors, as their business model is not as exciting as Brookfield, Google, Meta, or Amazon, but I believe Intact is by far the best insurance company here in Canada, especially in casualty insurance. And it is one of the best well-run insurance companies in the world. In fact, just this week, I bought 6 more shares of Intact Financial, and now I own 50 shares of this company inside my tax-free saving account. Basically, the position now worthing close to 13,000 Canadian dollar. The CEO, Charles Brandemore, is one of the best CEOs I ever seen. He spent all of his career at Intact Corporation. He's very disciplined, patient, and long-term focused CEO, and he's so serious about hitting their projections, especially the projections they make in their investor presentations. Intact usually able to exactly meet their earnings and return on equity projections, which is something I really like about this business. With an insurance company, you want a great management team, together with a growing income, a high return on equity, which is extremely important for an insurance business in terms of their capital allocation, and you also want a great combined ratio for underwriting efficiency. Most insurance businesses have a combined ratio close to 100%. Anything higher than 100% means that insurance underwriting is not profitable, and usually the margins are pretty narrow in insurance business. With most of the insurance companies in the industry, they have a combined ratio of 97-98. Intact Financial combined ratio in the last 10 years was consistently at around $90 or even lower than that. Particularly in recent years, it was mostly close to 86-87%, which means their underwriting is great. Their claim management is fantastic, and they are really good at what they do. Their return on equity is consistently over 10%. In recent years, it is close to 16%, which is really impressive. They were able to achieve these amazing numbers by using an efficient algorithm for risk management, by having vertically integrated claim management, and also by controlling the majority of the market share in their respective markets. I recently did a video on Intact and concluded that the stock fair value was close to 290 Canadian dollar. The stock is currently trades for 270 Canadian dollar, and in my opinion, it is undervalued slightly. Historically, Intact usually traded close to 2.7 times of their book value, and I believe currently it is trading close to this number, so this is historically has been a good time to pick up the stock, as it is rarely goes into any major dip. In fact, I couldn't find a single time in the recent history that Intact Financial stock was down for more than 12%, and currently it is down close to 15% from its recent all-time highs. The stock is not super cheap, but considering the quality of the management team and the quality of the stock and the stock performance in the past, I believe this is a great stock at a fair value. Let's look at a couple of short clips from recent interview of Intact Chief Financial Officer in a Scotiabank Financial Summit. In the first clip, Intact CFO and Executive Vice President Ken Anderson was asked about the current challenges of the business in the next couple of months.
Excellent. Listen, I thought about maybe we'll start the conversation if you can maybe give us your view on what you see as some of the key issues at hand over the next 12, 24 months, and really how your team is positioned for that.
Yeah, well, maybe I'd just start by maybe doing a little recap in terms of financial objectives. You know, the two core ones. Firstly, growing net operating income per share at a 10% compounded rate. We've delivered that over the last decade. And the second key financial objective, which is delivering an ROE outperformance of at least 500 basis points. And there, it's been north of 650 on average over the last decade. So very good delivery historically. And when we look at the first half of 2025, we see profitability, $9.25 of net operating income per share in the first half of the year. That's, a significant lift year over year. Profitability is really good. Combined ratio 89% in the first half of the year. And that's driven an ROE at 16.5% for the 12 months to June 2025. And that includes, some drag from elevated catastrophe losses in Q3 last year. So the platform is very well positioned, and that ROE in that north of mid-teens level is true in all markets that we're operating in Canada, in the US, in the UK. We're driving mid-teens operating ROEs now, and we're outperforming by at least 500 basis points in all markets.
Finally, Intact CFO talks about the future of the stock and what shareholders can expect from Intact.
It's excellent color. Listen, in terms of closing thoughts here, I mean, what do you see as the top 2 to 3 opportunities for Intact and its shareholders over the next 2 to 3 years?
Yeah, so I see the light is flashing here, so I'll be brief. I guess, I'll go back to what we said at Investor Day, and I think what people should expect us is to see us start to move to deliver on the objectives that we set out in Investor Day. Firstly, from a Canada point of view, we firmly believe we can take the Canadian business to 25 billion by 2030. So that's first and foremost in Canada. On the global specialty lines front, today we're in the 6.5 billion zone of top line. There we can take that to 10 billion by 2030 while sustaining that sub-90s combined ratio. And then on the UK and I overall, the goal there is to double the size of the UK and I business through 2030 as well. So, I think starting to see moves over the next few years that align with those objectives, I think is what you can expect, whilst continuing to deliver more broadly on the core financial objectives, the NOIPS growth, 10% compounded, and at least 500 basis points of ROE outperformance.
The most important thing that Intact CFO mentions here is that they are focused on hitting their projections numbers, and I believe we should expect to get these numbers as management team has a stellar track record on delivering on their promises in the past. Overall, I bought 6 more shares of Intact recently and will continue to buy shares of Intact, especially if we see more weakness in the share price. The last stock that I'm considering buying right now is EQ Bank. Like Brookfield, I already own a large stake of almost $22,000 in EQB, and it is my 5th largest holding. EQ Bank usually trades between 1.2 and 1.4 times of book value, and currently it trades close to 1.1 times of book value. I believe at this point in time, the downside risk is very limited with EQB, and there is a huge upside potential with the stock. They had a couple of disappointing earnings, but I believe most of the issues they had in the recent reports were temporary, and with cost controls and better capital allocation, they should be able to get things under control again. Their net deposits and number of customers, which are the most important and fundamental growth drivers of the business, are still growing. But the main issue that the company has was cost control, and particularly their allowance for credit losses on the balance sheet, which caused huge EPS miss for the company in the recent earnings report. I think the fair value of EQ Bank at the moment is close to 105 Canadian dollar, and the stock is trading for 93 Canadian dollar. Another major concern for me was the change in the management team at EQB after Andrew Moore, the previous CEO of the company, passed away. The new CEO, Chadwick Westlake, had an interview at Scotiabank Summit, and I personally like his responses to interviewer questions about the future of EQB. Let's look at this interview. In the first clip, we can see that he is pretty excited about coming back to be the CEO and to lead the company. It seems he brings a lot of positive energy, which I really like it.
In my belief at the time, including with the passing of Andrew, there was only one EQB, there was only one true challenger bank in this country. We're the 7th largest bank in this country. The future is very bright. So, of course, while it was very difficult to leave and come back, that choice to me, I didn't overthink. I was very excited. This is a dream job, a dream opportunity to help make the country proud, and the country needs us in a big way in banking, in competition. So I'm really happy to be here. It wasn't, honestly, this year you can't make this stuff up. It wasn't a straight line, but I am where I would love to be. I'm excited to be, and I'm very proud to be working together with the team and the mission now.
Next, Chadwick Westlake was asked about potential challenges in the economy and what is EQ Bank take on economy and tariff risks.
And maybe we can just jump right into EQB and maybe just starting with the broader economy. Everyone's got their own view. What's your view? I know there's been a bit more constructive commentary coming out of the banks in Q3 earnings season. The economy seems to be hanging in there given the tariff-related risks, and maybe a good scenario in 2026 versus what was expected 3 months ago. A better scenario. But what's your view?
Yeah, I think so. I think a couple things, right? I'm not, I wouldn't pretend to be able to predict the future. I think all of us, if we step back 6 months ago, a year ago, a couple of years ago, the path has looked probably a little bit different. What's key is how you manage your business model and the distinctiveness of your business model, how you invest through the cycle, the resilience of that business model. What I can say is from an economic perspective, you've probably heard a lot of fairly consistent views today from some really important CEOs that have been on stage that I'm very fortunate to share the stage with now too, for the one and only challenger. What I would say from our view, from our perspective, we rightfully have a view of cautious optimism. Okay, and you can look at that from different signals in different businesses. When you think of the single family side, the real estate side, absolutely it's been slower than we would have anticipated. I don't think it's been constructive enough to really accelerate that growth. But we are distinct in how we lend, where we lend, the markets we lend, how we're taking share, how we distribute. And you saw some signs of that they're almost masked in the last quarter with single family originations up 30%, the single family uninsured portfolio up 5%. And we're seeing some of those trends. And our hypothesis would be that the pent-up demand will unlock at a certain point in time, that there will be opportunities with renewals and refinancing, and we have an ability to take share plus share growth, market share growth naturally. So I think there is room to grow and to get that momentum going. We're pacing, we're thoughtful because we're not going to change our risk posture as well, just at the sake of growing. But we are seeing early signs of that in single family up possibility. Same with reverse mortgages that grew extraordinarily well once again. And we're one of two providers for that really in the country. And then the commercial side, you saw great pipeline continue where we're also winning very well in the CMHC insured multi-unit. We continue to have a very strong position. We believe the country, the government will enable that to be constructive in the future looking pipeline. And I think that market will continue. We expect consistent levels of growth in that. And that's a signal as well, regardless of where housing starts are today. We see a good pipeline for continued expansion there as well. So single family, commercial, I think it's positive, and have that sense of cautious optimism still, but being prudent and thoughtful in this environment that's very difficult to predict.
Next, EQ Bank CEO was asked about the last earnings report and why the stock was hitting hard.
Okay, so I have to ask the question on the quarter. Obviously, the stock was hit pretty hard. And I mean, you're like 7 days in now. Like, obviously,
is it 7 already? Well, there was a long weekend in there, Mike. They give me one day back.
I mean, you're clearly not. You weren't part of that process. You're not wearing this quarter. I'm sure investors understand that you're going to be given an opportunity to sort of refresh the strategy. I'm guessing at a 2026 Investor Day at some point.
Yes.
But do you have any thoughts on just high level on how the quarter?
On the quarter.
Yeah,
it's fair. I was CFO for a long period of time. I left, and a lot can happen in a couple of quarters. But what should always hold true is why you invest in companies, and you should invest in companies for the long term. And there should be a nature of predictability, stability, and you understand where the puck's going. I think what happened in the quarter, from what I've seen, and again, I appreciate it. This is early into week 2. I think we had a couple surprises. I don't like surprises. I would acknowledge surprises, and the surprises were the negative surprises were overshadowing aspect of the quarter. And I think there was 3 things. The margin contraction was more than expected. There was a one-time item in the quarter before that I don't think was maybe well clarified. We could have done even better. And the margin contraction was a little bit more than expected as we're normalizing that pattern. And I think that was an important discussion topic that I think people want to understand, because a bank shouldn't shift that much in a quarter. So I acknowledge that we need to do better, and we will. And it's not consistent with our normal performance trajectory. Credit was another aspect where we have an exceptional trajectory over the past many years. We actually put it in one of our investor presentations how our PCL ratios perform through the cycle versus peers, and we are always the lowest on the PCL ratio than everyone else by far, and you know that well too. But the PCLs were still higher in a back-to-back quarter than expected, I think, on the impaired side, and even a little bit more in the performing. And I think the question was, did we reserve enough previously? And what do we believe to be true about some of the impaireds, including on the single family side? That was one of the ones that surprised people. And what's true about anywhere we saw anything unique come up? So that was a bit of a caution on are you there yet or not on PCLs? And then I think the third one, Mike, was expenses. The expenses definitely increased more, and that's resulted in some negative operating leverage, which is inconsistent with our performance. And one of the things that I declared, and we could talk more about, is I believe our traditional strength in efficiency being a competitive advantage is important. It's very important. And I fully intend to move it back to being a competitive advantage. And that comes back to how we allocate capital, the choices we make, and where we're focusing on doing a few things really well and where we're winning. So those few things, the margin, the PCL, and the expenses, I think were points that masked the great growth in single family, the loans under management expanding, the exceptional growth in EQ Bank customers and deposits. So it was a bit of that narrative. Plus, to be honest, it was my first week. You have new leadership. We've gone through a lot of leadership change that I know we can talk about. And I think just a lot at once.
And finally, EQ Bank CEO was asked about the stock valuation, capital deployment, and even share buybacks and dividend. Let's look at this clip.
Okay, that's super insightful. Thanks for that. Maybe on capital deployment, obviously it's organic growth first and foremost, and especially as the market maybe recovers starting in the next few quarters for not just EQB but the industry more broadly on the lending side. What about M&A? I'm sure there's always M&A opportunities. And then dividends is something that I think is interesting because you've got a pretty sizable NCIB. I think it's around 6% of your shares, and hasn't really been utilized lately. I'm guessing it's because of the transition here on the leadership team. What's your view on M&A and on the buybacks? And given where the stock trades, in particular on the buyback, would you not be more incentivized to be buying now, I guess?
Yeah, I'll say a couple of things first. As an investor and me personally, I'd always look at why would I buy or buy more of a stock, and what do I believe to be true about capital allocation? And I think there's reasons for all of those, but I'll tell you, me and our company are buying more of the stock because it is so far below intrinsic value. We have historically not done that. So I'll say that quickly. We have an NCIB. Historically, we have not bought back shares. Our first principles are invest in the business because there's so much to invest in and grow, and there's so much white space around us. That's the point. We don't have more downside. We have the upside. We're at a certain platform where the growth is the focus, and we need to make sure we're investing in our core products to get there. So we are going to keep investing. I do believe inorganic can continue to be part of the equation for us, where it's very selective, aligned to our strategy and the things we've talked about for years. Not going to do a bunch of new things, but we've made a couple really smart transactions that are working out extremely well for us. So could it be a possibility opportunistically? Partnership and inorganic, yes. But I would say otherwise, yes, we have the dividend strategy we declared last December. We'll continue that. But buying back, we have an NCIB that we increased in January. But we haven't used it historically, so you have natural limitations. If we have actually continue to have significant excess capital, we will put it to work through buybacks, and you can expect to see that. And we don't have to debate necessarily at the moment intrinsic value, but we are dramatically below that. So we are buyers, and we will be buyers at these and higher price points. And what I won't do yet, Mike, is quantify, hey, precisely this quarter, we're going to buy 100, 200 million. That takes a little bit of time, but I can say we are buyers, and this is a discounted stock. Plus, we are investing to grow the franchise. And like I said, we have hundreds of millions in excess capital, and we're going to put that capital to work.
I like how he tries to focus on long-term returns and how the CEO believes that the stock is undervalued here, and even mentioning that they are going to buy back shares as it is so cheap. There you are, guys. I hope you enjoyed this long video. That's it for today, and I hope to see you guys in the next video. Farewell.